Good morning, everybody. Welcome to the Flow Show. We've made it through to Friday, the day after the night before, and everything that went on at the ECB. Hope you all traded safely through that. We'll have a look at everything that went on today, obviously. Morning, K-Man. How you doing?
Hey, good morning, Ryan. Well, I'm glad it's Friday. On the other hand, the week went so fast, I find, that I'm so afraid of a much too short weekend to come.
Yeah, I get that feeling. They should swap it any other way. They should make weekends Monday to Friday.
Exactly. I'm going to need an extra day.
Yeah, exactly. And we've got no bank holidays to look forward to either. So, no, tough luck, mate. We're in it till Christmas, and then we'll get some time off. Right, let's get cracking. Lots to get through today. The PBOC, cheeky little buggers. Just as we were finishing up the Flow Show, they decided to cut the RRR yesterday by 25 pips, although there wasn't much of a reaction in markets at all. Dollar China went up a few pips. The rest did nothing, which is probably the first time I've seen an RRR cut not have that much of an impact on the market, although, as you'll know, or regular viewers will know, it has been touted for long enough, at least for the last several months. They've been talking about this period as potential point of cutting the RRR. It comes on the back of loads of other cuts to MLF, LPR, mortgage rates, you name it, they've been cutting. So not that much of a shock in the end, but still surprised not to see a bit of a knee jerk on that one. And while we're talking about rates, they left their 1 year MLF unchanged last night. They did do a reverse repo operation, a 14-day reverse repo, and the rate on that was lower by 20 pips at 1.95% versus 2.15% the last time they ran one of those. So still easing things there. On the manipulation front, the currency control front, apparently China has told some FX brokers now to cut proprietary trading this week. So further putting the tightening screws on what people can do over in China. There was some data out, and better data for China at least. There we go. Industrial production, retail sales, all looking better. Oh, excuse me, just had to sneeze there. Industrial production looking better year on year, 4.5%, beating expectations. Year to date, coming in as expected, but still a pip improvement. Retail sales up as well. Year to date, retail sales, though, not looking as hot, but still decent numbers there. Unemployment rate as well, coming in at 5.2%. So finally, some good news for China. Does it mean anything's over in terms of negativity? Of course not, but you can ask questions about their data reliability as well, but the numbers are what the numbers are. China's National Bureau of Statistics said that the economy saw an accelerated recovery, although domestic demand remains insufficient, so they're not counting their chickens just yet. Over at the Bank of Japan, there's been a story out, a sources piece out, saying pretty much that the market misinterpreted Ueda's remarks when he came out about talking about ending negative rates. According to the people who spoke in this interview, most of what Ueda said in the Yomiuri interview was consistent with his routine remarks of late. And taken in total, his comments indicate little change in the view among officials that they'll need to weigh both upside and downside risks in deciding whether to adjust policies. So basically they're saying that the market overreacted. I don't think it has. I think it made the right reaction. And I think Ueda still tipped the nod a little bit at what's potentially to come if all the ducks line up going into the end of this year, into next year. What did you make of that, Kay?
Absolutely. Absolutely. We know that there's been a bit of it's Japanese, right? We know that there's been a bit of lost in translation, perhaps on the timeline and things like that, which I also talked about. But I think the market somewhere did not overreact. Now the reaction that we have seen during this week is a gradual unwind of the moves in the yen, but that also has to do with the other currencies. If you look at the JGB market, we are a couple of BPs or higher than we were the week before. So I think in that respect, the market has had it sort of right. And then what happened to the yen? Okay, you price out because after all, ECB hiked, and we had other data elsewhere in the market. So the yen is back to its lowest levels, and I think all in all that is about right or understandable in the yen reaction, but also right in the JGB reaction. So I don't think the market. Okay, the market may have overreacted because it's Sunday night opening. And on the Monday, you got less. Monday morning, you got less liquidity, and then we did the low there. Okay, but I mean, it was not the wrong reaction. Let's put it that way. But then gradually you come back to the fact that what it did say is probably that it's going to be very, very slow. And then you have in the mix that quite big package that the government is going to put in place. So. Yeah, I think no. I don't think the market the reaction was wrong. No, I agree with you. I think it's probably the correct reaction that has been seen. Yeah.
Yeah, exactly. My thoughts exactly on that one.
One thing on that RRR in China that you spoke about before. I think it's just clear that speculators are now starting to doubt whether they still want to be perhaps in the market at all. I mean, the big speculators tried to take the Chinese yuan weaker, right? Because we saw a pretty decent reaction on those numbers overnight, and then their constant efforts to have people not buy foreign currencies or not sell the CNY or the CNH. So. And that has now really taken a hold in the market, and I reckon we are going to see more of this range trading. But perhaps the speculators have just said, like, oh, all right, let's just leave it for what it is right now, and we come back to it. We revisit the Chinese yuan later. That's the impression I've got.
Yeah, well, the way it's going in China, the speculators won't be able to trade it soon. They're stopping trading over there, so. Yeah, maybe force the hand of at least Chinese speculators or those trading the onshore stuff. But anyway, yeah, we did see the one gaining on that over the data and stuff. But it's a little bit of a bounce back. We're getting down to these levels. We had a little look under this sort of 727 area. Didn't quite get down as far as 725, so we got in, just under a couple of pips under 726. So this whole area is still the sort of sticky support zone that we need to watch, and there's another band under there. So it's all, there's a lot of levels. You can probably pick a level anywhere you like at the moment within this one. But there are big points. If you look one of the big areas, it's still down at 711, 712. Maybe even 710, call it. So there's lots of little areas to go. The main thing I'm taking on board here is that the bounces are getting hit. So long as that continues, I'm happy to stay on the short side and see where it wants to go. But yeah, not going too far just yet. But if the data continues to pick up, then the market may take a different view on that, and we'll see some strength. Right, let's move over to the Queen of Sunbeds, and the ECB hiked by 25 pips to 4%. So the market was right in ramping up rate hike expectations since last week. Even though I thought there was a greater chance of them hiking the market expected, it still was a bit of a shock to see them actually hiking rate, but it came with the huge dovish line, shall we say, because the ECB said in the statement that based on its current assessment, the ECB considers that interest rates have reached levels that, maintained for sufficiently long duration, will make substantial contribution to a timely return of inflation to target. So, long and short, they've peaked. That's what they seem to think. Their rates are at a level where they don't need to do more. The door is obviously still open. The door will never be closed until inflation is well back within the box. But all the conversations and comments from Lagarde and co suggest that we are potentially at a peak. So in that sense, as you'll know, all our analysis over the last few days has been, a couple of potential outcomes, one of which being if they hiked, it would likely be the last hike and put a top in rates. And so it was. We didn't quite get the pop in euro dollar I might have expected when they announced that hike. I thought we might get a bit more on a surprise hike, but then the market was largely leaning towards that side, so that's probably why. I think we went from 28s to 50s in that move, and then it was south from that point after. What they did do is confirm the hike in 2024 inflation forecast. They took them above 3% to 3.2%. 2023 got hiked to 5.6% from 5.4%. 2025, which we don't really need to worry about too much just yet, got knocked down a pip to 2.1%. Ms. Brayton said in the coming months, inflation will fall, services are weakening, but the economic momentum should pick up as real incomes rise. Did warn that some long-term inflation indicators remain elevated and need to be monitored closely. They didn't discuss PEP reinvestments. The only real hawkish note she dropped was that they can't say that ECB rates have reached their peak, even though everything points to the fact that they have. After that, traders started pricing the cuts. Now we're pricing 75 pips of easing in 2024. The next meeting, the rate probability is 26th of October, 90% to keep rates unchanged. Now we're also lacking sources stories, usually come around 4 o'clock our time, 5 o'clock our time, and there was none, but we did get one early this morning from the FT saying that ECB hawks are warning of a December rate rise if inflation and wages stay hot. So the hawks are not quite ready to give in, but really the only thing that's going to force the ECB or the market to get hawkish on the ECB is if inflation starts going higher and things like wages go higher as well. So we're not out the woods with hikes just yet. Inflation has been moving the right way in the Eurozone numbers, but we've seen various countries, Germany, I think it was France and Spain, inflation going up. Italy is one of the one majors where it's still coming down. So we need to watch for that because if inflation does start building like we've seen in the US, then that's going to bring hikes back into the table as far as the market's concerned. But for now, market's got its peak ECB, and we're going to be playing the rate cut trade, as we've been saying for the last few weeks, into the end of the year and next year. On that front, Citi now see ECB rates cut starting in June of 2024 versus their prior call of September. As usual, the floodgates are open on all the ECB chirping birds. ECB's de Guindos says CPI and core will continue to ease, and that rates at this level for some time will be enough to tame CPI. Now, we did drop in a strange comment. He said any future rate cuts to depend on many factors. What's strange about that is even uttering the word rate cuts and talking about even loosely what it would take to get in rate cuts. With the ECB topping out on rates, if they start talking about cuts, they're going to feed the cut expectations, and that's going to undo a lot of the tightening that they've built up through rate cuts. I don't know whether he was been misquoted or something like that, but Lagarde is not likely to be happy with talking about cuts at all. He may not be saying anything big, but the fact that he's used that language is not going to be seen positively. ECB's Muller, who's central to hawkish on the scale, says no further rate hikes are expected in the coming months, but higher inflation could warrant yet another hike. We also had finance ministers, PMs and government officials alike all jumping up and down in glee that the ECB may be at peak rates. I think it was someone out of Italy, I don't know if it was the economy minister or PM or whatever, said it was a mistake for the ECB to hike this time, but be happy that they'll all be done. So, Kay, what are your thoughts?
Well, going a little bit backwards, it all depends if the Windows replied to a question, you know, because sometimes you just see a headline and he may just have been replying to a question. But it's well, and then the sources. I think we had the sources ahead of the meeting this time instead of afterwards. But it's funny that and they went through. Usually they go through Reuters the after the meeting, right? But it's funny that the Hawks found it necessary to go and talk to the FT this time. I've got the impression that the balance really shifted at the ECB. They, of course, the large majority voted for the hike, which was sort of expected. Then in the end, we had a big rebalancing of expectations just the few days prior to the ECB. Yeah, I think if the Hawks found it necessary to talk to the FT, that means that there is a clear shift in the balance, and that the doves are trying to make themselves heard more. So that puts, and I also think that Lagarde in the statement and in the presser, that there was a clear shift. She can't say it, but there's a clear shift. She was a lot more hawkish during prior presses, and that puts it all neutral right now. And I think the market reacted to the fact as well. The market reacted to two things, in my opinion, and that's the fact that she said they may be done, and the total silence around the PAPP and their asset pro and QT also, because I really thought there was a very fair chance that if they would err on the dovish side on the one hand, saying that they may be done, maybe talk about QT to keep the market on its toes, but they failed to even mention it. I mean, it's exactly the same statement as the one before, and even those ones before. So I think that's where the market went like, oh, hang on, that's maybe not great. And then the market then shifted back to pretty rapidly to the fact that the data in Europe are just not as good as well, for a starter in the US. And so yeah, I can understand the market reaction. I'm positioned as well for it. The question is now, what's next? We've seen the euro crosses as well getting really hammered, and barring the yen, but that's a different story. But I think we are now, of course, it's easy to say over to the Fed, but I think we are now somewhere where we think, or where I think we should be at this stage. And that's why I also cut a lot of my euro shorts, and actually all of them right now, just for the day. I still think that the euro is going to remain heavy, but we are sort of where we have to be. And I reckon that also translated, despite higher and better US numbers yesterday and higher yields today, that the euro dollar is not tanking beyond that 106.35 and even falling a little bit short of the 106.10.15 big support zone. Is it because probably the market is now saying, or a little bit too positioned, or is now saying we are sort of where we want to be, and now we are, and of course we all are, but now we are really going to need data tell us if we have more divergence between the one and the other economy, for instance. That's sort of where my head is as well right now.
Yeah, I agree with that. I mean, we flip-flopped around that sort of 107 level over the presser, and it wasn't till afterwards that we really sort of made the move, much afterwards, and then obviously it was all downhill from there on. But yeah, I agree. This is euro dollar, so it is the most liquid pair, so it's gonna perhaps not go as fast as maybe some would like, or maybe some would expect. We pretty much matched that low back in May. So found the next level, hit the next level, bounce on the next level. I personally, I think we are. What I was watching for this month for all the central banks is what was important. Was it inflation? Was it growth? The BOC said it was inflation. The ECB hiked on inflation. And now the attention is going to switch to the growth side of things. And that's what we've got to look for now, and plan this cut trade for the next few months. I'm happy to play. Go on, mate.
I think, well, I've been saying that for a while now, that the attention should be going to growth. And I think that's actually what the market has reacted to over the past sessions already. Because if you see in the data, for instance, you look at stuff like, and then you don't only look at euro dollar, but then you look at those crosses, and that's where I think the euro's weakness may still be coming from as well, is that stuff like the euro Aussie, well, the Aussie was very offered as well until a few sessions ago, but then you see the euro Aussie week and the euro Canada week and stuff like that. That's where I think the market has already been trading this story for a little while, and then perhaps yesterday had the confirmation, as you say. Saying like, oh, all right, guys, I mean, we know about inflation. We knew, but now we know. And now let's see what's and that's why I mean as well today. I mean, let's see where we go from here.
Yeah, I think you're right. The market, has been all over the growth story, because it is an important story. Even if the central bank's all about inflation, it is an important story. And I think yesterday, the ECB removed the final hurdle in taking away further rate hikes. That's a risk. If you want to sell a currency on growth worries, you've got to remove the risk against that trade, which is rates continuing to go higher and staying higher. So that hurdle's been removed now. So the growth traders now sort of have a clearer path ahead to trade it. And we're going to find out later today what that means, because we get some US data. Taking the US data yesterday, we had strong retail sales coming in, although a lot of that has been put in as higher gasoline prices and sales at gas stations and whatnot. That's been a lot of the driver. Retail sales, you can see that up 0.6, beating expectations. But strip out your gas and whatnot and autos, it's a little bit softer, 0.2%. The control group near enough flat. So on the headline it looks good, but when you go between the numbers, they're all still positive, which is good in itself. You're not seeing any negative retail numbers, but there's a bit of difference between what's actually driving those good numbers. PPI up as well, which falls in with the inflation picture. Again, some energy pressures, shall we call them that, coming in, but you can see even with the numbers where they're stripped out, still bouncing there. So this is going to feed through into inflation. So there's still some signs of stickiness in the inflation data. We've obviously had the CPI numbers going up 2 months on the trot, even with the core coming down. PPI is ticking up as well. The pressure's there, and that's the fear for central banks. As I said, BOC all about inflation, ECB all about inflation, the Fed is going to be all about inflation, though they may take a stronger look at the growth side of things as well. The Bank of England, they're going to be the usual mess, I think. Are they going to look at inflation? Are they going to look at growth? They'll be worried about it all. I've no idea what excuses they're going to come up with next week, but we'll worry about that next week. But again, I think the risk is higher for the Fed to hike than the market expects. Vastly more. I think we're pricing still 95% of keeping rates unchanged. You know, at least with the ECB, there was a 30% chance at the low end before coming into this week. The Fed, everyone thinks it's there's no chance. So that's going to be the bigger shock if we see the Fed hiking. And I say it's a bigger risk than the market thinks. Anyway, initial jobless claims are out as well. They were pretty good. Tickety-boo coming in at 220. So staying in those 220 is a bit higher than what we saw last week, but you know, still nothing we need to worry about on that front. So right, back to the prices, and say for euro dollar, I'm a bit more bearish now. You know, we talked yesterday about the simple trade. It's the 107 line. Well, we broke it, we're under it, we're staying well below it. That's your marker at the moment. That's your marker through today. That's your marker going forward. If we get up to there, hold it. Maybe if you miss shorts on this move, that might be your chance to get in some shorts against that level if it holds. If we get back above and it starts holding, then it's a different picture entirely. The third way that can happen is we just go up and we bounce up and down, and we maybe form a range between 107.60 and 106.30, and we go sideways and the level washes out. So doesn't matter what you want to do, there's your number. It still was important today as it was yesterday. Cable, that followed the breakdown as well of the 124.50, though it's only got down to the big figure, give or take a couple of pips. The moment we've had a test close to it, 40s, and it's resisting for now. So the break here is holding there. So again, another one line, one area to lean your risk against and judge what this one wants to do going forward. Dollar CAD, that's got down to the zone. We've had a move down. What's not good at the moment is the bounces are very weak. We're not even bouncing, you know, taking these lows, 25, 30 pips is the limit at the moment. So this trend, this turn that we saw off the highs is still in play. We got this all traffic zone. So the whole area down here, as we've been showing, is a zone down to 134.70s. So just keep an eye on these prior lows. The last time we were down here, we did break into 134s, not too far. So we're doing the same thing now. So it's a bit of a knife edge, this one, which way it's going to fall. If we go through 70s and the fib, well, then maybe this trend is really starting to turn around. If we hold here, then maybe we're pushing up. Obviously, as we've been noting over the last few days, more influence coming in from oil now. I think on the CAD, this continues to move up and break up, and that's weighing more and more on dollar CAD. So the influences for CAD strength are still there and increasing bit by bit. Gold, I know you guys like to look at gold, and I will remember your trade in a second, Ali. I haven't forgotten it. I've been keeping half an eye on that. Well, I can't even find it. Keeping half an eye on that because we did have a little probe of the 19 level. I've been looking for this 1880s, this old fib area, 1895, just potentially look to play the range between there and 1986, but we've held at the big figure on a first test. The bounce has been decent enough. Your intermediate level is still up at 1930s for that one. But if we get a look down at that 1885s, 1890s, I might have a little nibble long, just as I say, to play the range there, but not too interested while we're waffling around these sort of areas as well. Cade, you got anything in particular you wanted to highlight on this one? Oh, and while I'm handing over, I'll just
okay.
Can't
I,
remember.
I don't have much to show, but I can show just a few because just to continue on the metals. And while I'm putting up my screen, we have to mention Angela yesterday, right? Who made the call live on the Flow Show, saying that she was long FTSE. Angela, I hope you kept it and you rode it all the way, because that was a very good trade. When we look at where we are now in the FTSE. So well done, Angela. So let's have a look at what happened here. So we had this this move on the differentials here, and now we're seeing that it's really flattened out. Okay, so it's been reflected on what the euro dollar is doing right now as well. We are stabilizing, and I want to and so we need probably a new catalyzer to take stuff away. I'm still bearish euro in my bias, and of course the 107 is one thing, but then as well you can add to that the high 107s, because we've broken through this channel earlier. The thing though is that we stopped, as Ryan already mentioned, around 106.35, the prior low. And then we have, whether it's in the longer term or whether it's the bounce, we have those levels here, 106.13, 106.14, call it 106.10.15. And I think that really needs to give way now to confirm that the euro is going to go lower still. And then I reckon we may be looking at stuff somewhere in the low 105s or even 104s. Okay, I'm not sure it's going to happen today, because the interest rate differentials are not really showing that we are going to go very far from where we are now. But the US yields are ticking up as well, so that should keep the dollar somewhere supported. And also the FX vols are really coming off after the event. It's always logic, but we are trading at levels like the 1 month euro dollar is back down around the 660 zone, which is in the latest terms relatively low. So the options market is not expecting that we are going to make big waves. So for a continuation of this euro dollar to go down, we really are going to have to take out these lows 106s. All right. If not, I see a more sideways pattern for now, and then we are going to see what those data give us, like the Michigan this afternoon, industrial production out of the States. We know that in those manufacturing productions, we know that it's all been a bit weak of late across the globe. So keep an eye on those. They may be the ones that trigger an extra move. Now, one that we really need to look at is this sterling. Okay, so it held this trend line here. It also held the more medium-term trend line. So I think the factory holding there is rather interesting. So that's going to be your level now to watch. If it really breaks below 123.90 figure, then there's a possibility to go to see 123s. But again, although those yields are rising in the US, I'm not sure that there is enough power today to produce this move. So I think going into the weekend, and I don't know whether things are really going to see big moves. If we get back above 124.5, then I think there's going to be likely a bit of stop loss hunting back up to 125. The figure, let's say, this though is going to be this 125.5. I would really mark it down on my pad if I were you, because this is the level that I'm going to really watch very closely now. Because if we start to get back above there, I think something may have changed in the dollar. Okay, so we always have to if we have a bias, we always have to look at certain levels or try to identify the level where the thing could change, where the market could change. And I think 125.5 is going to be such a level in the cable going forward. And then we need to talk about those metals, all right? So Ryan already showed that that level here is holding. The trend line support is holding. Then we have this 1885 below there, but we've seen a pretty. Oops, sorry. But we've seen a pretty decent bounce in the metals of the low, and it looks as if the market was trying to push them a little bit too much. I think it has more to do with positioning than anything else, and with the fact that stuff always looks the most bearish at bottoms and bullish at tops. I think we're in a range here right now. We need to really get above those 1930s again to get going. One that was really had a spring there was silver. We went really close to the quite important support line here around 22.25, which I showed, and then now we're already back trading above 23. And that was looking like a real piece of shite yesterday. And we are nearly 4% higher. I think for next week, this is going to be important for silver, what's going to happen. Because if we retest, and I think that there's a couple of, or more than a couple, of too conservative buyers left behind there. And I would really pay, myself included, by the way, and I would really pay attention to what's happening if we get a retest of this zone and hold again. Then I think I'm going to press some buttons because I think we may have seen the bottom. If we start to break next week below 22.25, somewhere around there, then there is that chance to go and have a look into the 20s. All right. That's still a possibility. But if, for instance, if China starts to produce better numbers, this could actually hold very well and start to move up again. And then we need to have a quick look at what's happening in the S&P. Okay, there's been a lot of questions about why the S&P is going higher again with the US yields ticking up again. I think quite a few people were trying to front run what's going to happen on triple witching Friday today, which I think, if I read this right, the last 10 out of 11 Septembers, the triple witching Friday in September produced a lower S&P. And I think a lot has to do with people trying to front run this, and now they've been forced to cut their positions back through 45. But we are on decent resistance, all right, in the S&P. So this is one, I think 45, 15, stretch it to around perhaps 20 or so. This is going to be your level that you need to watch for the close of the week and then the start of next week. And to come back to what Ryan was saying about the Fed, if the market really underpriced a possible Fed move, I'm in the majority camp. I don't think the Fed will move. I don't think that CPI print, when we look at the core especially, I don't think the CPI print warrants any rate move. But if they would surprise us or send some strong signal on the dots, for instance, this could really be your level that is going to cap it and send the thing lower finally. Okay, but we're going to have to see how we start to trade next week, because if it goes up, I think there's a few shorts in there who are going to feel a little bit of heat. All right, so keep this level in mind. I think it's important enough. Right. Oh, just a quick word about this yen, and I think you have to look at crosses for the yen. Look, this Aussie yen has broken. I already showed this one. I'm a little bit long of it. I bought it. Yeah, I bought it before. You know, I bought it no, I bought it here on this level here. I think it's broken up. And for as long as we are now, but I'm cautious into the Friday, because remember last Saturday we had an article that said dollar yen 150 points lower, so I don't want to really run into that. And we also look at a very weak yen trade weighted index. So I am managing the position actively and putting some protective stops in there as well. But it's breaking, right? I mean, those yen crosses are breaking or are very well supported along trend lines. This is your Kiwi yen. You can look at the euro yen as well. Even over the ECB, you know, we went below there, but we stopped at the 38.2, and we're already back below above that trend line here. 157 being a bit of a pivot level there as well. The yen is still weak. The yen is still weak, and I do think we might get a little bit of speculation, as I already said, into the Bank of Japan, but we are retesting the highs there on the dollar yen, and if those yields remain high, if there's no big accident on the triple witches, which sent the S&P a lot lower, if that would not occur today, I think we may end the week on a fresh high here. So get above here. I think we're talking about 148.80s. Will there be a panic run to end the Friday? Possible, but remember, that's going to send the yen trade weighted index a lot lower, and if that would occur today, I still would not rule out any more comments by Japanese officials before the week is ending. Ali, triple witching can also affect forex markets. There's so many correlation algos now turning in the markets, right? And yes, it will have, because if we looked at what was happening on yen pairs on the prior dip in these S&P or equity markets, it did drag the stuff down, but it's not your base correlation, what is running in the markets right now. If you look at stuff like the yen, for instance, it's going to be much more influenced by what's happening in the US 10s and the differential with the JGBs. All right. But yeah, I mean, if you are in a broader risk on, risk off environment, which I don't think we are in right now, but if you really trade risk on, risk off, if there starts to be some accidents happening on growth, on jobs market, then I think this correlation could get a lot stronger again. All right. Any other questions before I give it back to Ryan?
Angela got a target, so that was very nice. Well done, Angela.
You got your target. Great stuff. Well done. Like to hear that. Like to hear good stories about traders, because every time I open a broker platform to even check on something, I see that still 70 or 75% of traders are losing money. So we like a good story. Ryan, back over to you. I'm done, mate, for this week.
Thank you very much, mate. I'll just share it again. I know you've looked at it, but just to emphasize the point here, can you see my screen okay? Yeah, this, I think we're setting up for a bit of a blow through here. Just looking at the price action now, which could take us up into the 148s and these other levels of resistance points after we had that move up and the failure 152s. So that's probably the target here. If we do break up above these levels now, it is looking a bit poppy. So be careful if we do take out the recent highs up here. There may be a few stops sitting above there. As far as the majors goes, you're talking about the euro, dollar, cable, what they're doing at the moment. The fact that they're creeping up, probably, as Kay says, more to do with these yen crosses all pulling them up a bit. Because as you can see, pairs like dollar CAD still sitting on lows while dollar yen is on its highs. So that shows you where the influence is, that it's not all the dollar at the moment. It's pretty much yen led. So let the crosses be a guide a bit to what the majors are doing. Those yen crosses more than the dollar right now. Things could change when the US comes in. It might switch over to recognizing what the dollar does. But if we do break here and we do get a bit of a blow through, it's probably too late in Tokyo to get the talking heads out, but I would expect them to start popping up again from Sunday, maybe.
Don't be so sure.
No, they'll be watching, but we don't often get the Suzuki's and whatnot coming out, giving the we're watching closely lines at this time of day. But they may do. If they do, they'll show that they are watching. But I would expect it more to hear that from early Tokyo time, Sunday night, Monday morning, if we're making a break here and pushing up quite hard on that. And then we'll be playing the intervention guessing game again. Whoopee. Anyway, we should call that a session for today. I hope we've answered all your questions. I hope we set you up well this week, coming into all these events with our analysis and advice on how to trade through it. A lot of you seem to be doing very well already, like Angela. So well done there, and Ali with his little scalps here, hither and thither. So keep up the good work. Thank you all for coming to the Flow Show, and do check in with us next week as well. Thank you to Steve and all the guys who run things in the back end to make these shows work. And obviously, thank you to K-Man for joining me and giving all his valuable insights and coloured pictures on all the pairs. Have a great weekend, everybody. Remember, Friday's pips are beer pips, and we shall see you all next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.